Jenny Brown and welcome to this week's MFB News. I hope you're all keeping very, very well. Lots of changes to report for you this week, more pricing downwards and a little bit of lender criteria changing as well to share with you. So some good stuff there. I'm also just going to talk to you about what I imagine is a lot of landlords' least favourite subjects. I know for sure it is mine. Tax returns. I am that person who on the 29th of January is scrabbling around trying to get the numbers together to submit their return. I'm sure most of you are far more organised than I am. But what we're going to do is just explain to you why you actually do need to apply for your tax return now if you are going to be looking at taking a mortgage in the coming months. Okay, so the lenders, so the pricing is still edging down amongst lenders. It does certainly seem to be those lenders who are more in the specialist end of the market making the, what I would call the more significant changes. We are seeing the more vanilla high street clearing bank type lenders also making pricing, but it's certainly not as frequent or as aggressive in terms of the price cuts as we're seeing in the specialist market. Now in the specialist market, we define that as lenders who lend on to limited companies, on HMOs and multi-units, or to those landlords who are portfolio landlords. So actually that will encompass a large chunk of the people who are watching this video, so that's really great news. But like I say, actually there is some movement in the more vanilla end of the market, so lenders who lend to people with smaller portfolios or just one or two properties in personal names on very, very straightforward properties. And there is some movement there, but definitely not as prolific. So first of all, we've seen Precise make some changes. Now, Precise had introduced a few weeks ago some limited edition products which were they were really good actually. So Precise, to go through this, they tend to release some sort of knockout really great rates on a limited edition basis, and what they would do as a lender, and this would apply to all lenders, is they would say we're going to lend X millions of pounds on this particular product, and once that tranche of funds has been used up, then it's gone. So what they've done is they have used up the funds on their limited edition products rather than replace it with more limited edition products. What they have instead done is cut the rates on their whole product range and also lowered the arrangement fees. So they now have pricing starting from 2.79% for properties owned in personal names and limited companies. They have rates starting from 2.89% for the HMOs and multi-unit offering, which can be again personally held or limited company. Now for Precise, if you're looking for an HMO or multi-unit property, the maximum number of rooms or letting single self-contained units would be 6. In terms of Precise, they are definitely what I'd class as a specialist lender. No minimum income requirement, no maximum properties in the background. You can be up to 80 at the point of application. Now for their limited company offering, it's very, very solid. Definitely more at the vanilla end in terms of what they will and won't accept. So they're looking for flat structures, so a company owned by people. No company owned by a company owned by people for these guys. They do want it to be an SPV, and they're going to take their personal guarantees from all directors and shareholders. So this can preclude some people who have got slightly more complex share ownership structures in place. But like I say, the rates have come down and they're very, very good, which more than compensates for the fact that they've removed their limited edition products for now at least. Capital Home Loans have made some pricing reductions in the last week too. Now Capital Home Loans are a lender who, for those more long in the tooth of us, will remember from pre-credit crisis days. They went very quiet, they weren't lending for a long, long time. They've come back to market in the last few months, and I have to say so far they are really impressing us. In their heyday they were a very strong brand, very, very good at lending to on limited companies, HMOs, multi-units, that kind of thing, so a true specialist lender. And back in the pre-credit crisis days, when there weren't as many lenders as there are these days in that space, they really sat at the top of the tree, really alongside Paragon. Now they're back, they're really, really good. Like I said, they're really impressing us with their service, their criteria. Their rates have just come down several times. So they're looking really, really competitive. So their limited company and individual rates on standard properties are now starting from 2.88%. The HMO and multi-unit rates are now starting from 2.99. For these guys, again, it's 6 rooms in an HMO, 6 self-contained units in a multi-unit. Now, one of the things that they do, which is really nice, is that if you have a property which is let to multiple tenants on individual ASTs, so what we would class essentially as an HMO, if the property is unlicensed, so it doesn't require any kind of licensing, they can actually lend on their standard products rather than their HMO rates, which is a really, really nice feature. Now, in addition to this, on their limited company offering, they can accept trading companies. They can also accept layered company structures. They do need the applicants to be earning, between all of them, £20,000 per year. There's no maximum number of properties in the background. They can do day one remortgages against open market value. And they do actually allow you to overpay 10% per year, which actually might not sound like a particularly exciting feature. But not all lenders allow this, particularly in the limited company space. So actually for those people who do like to kind of knock chunks off here and there, they do offer some flexibility within their offering, which is really, really good. TML have made some improvements to their lending criteria, which has largely been centred around maximum loan amounts. They've increased their maximum loan amount for an HMO to 2 million and for a multi-unit block to £3 million. And this is at 70% loan to value at that level. They can go to 75% at lower loan amounts. So for these guys, 6 units for a multi-unit, please. 6 rooms on an HMO, but they can consider up to 8 rooms by referral. So by that, what I would mean is that you would essentially send us the property details. We'll then contact TML, have a chat with them. They've probably got a asset manager who will also have a look and see whether it's something they'd be willing to consider. In my experience, TML are incredibly open to trying to do business. So there's every chance if the property is decent enough, then they would be happy to go ahead with that. They've also increased their maximum loan for new builds to £2 million, increased their maximum loan for flats above commercial properties to £2 million. Now, they've also made some changes to their kind of appetite for exposure within certain blocks of flats. So what I mean by that is, what you will find is if there is a block of, say, 10 flats, a lot of lenders would say, well, okay, that's fine, we'll only take on 20% of the development or 15%. Some can take on more, but it does vary. But TML have reviewed their kind of exposure limits, their concentration limits, and they've increased them, which is great news. Now, in terms of TML and who they are as a lender, they're a relatively new-ish lender. When I say that, they've probably been around for a few years now. Definitely a specialist lender. Their pricing reflects this. It's not horrible, but it's certainly not kind of, you're not going to find a 1 at the start of it, put it that way. But they're able to lend to limited companies, SPVs only, but also individuals, no maximum properties in the background, no minimum income requirement. They can accept people of age up to 80 at the point of application as well. Rates, they start from 3.38 on HMOs and multi-units and 3.13% on standard properties. So great to see TML making some improvements to their lending criteria there. Keeping it going with changes to lender criteria, for now we have seen a new entrant into the 80% loan to value lending space. Welcome to that arena, Zephyr Home Loans. They have introduced some new products at 80% loan to value. The pricing there starts from 3.89%. It's available to limited companies and individuals. Now, Zephyr Home Loans are definitely, again, another specialist lender. You can see what I was saying at the start now in terms of the real movement in the specialist space here. They're able to lend to limited companies and individuals, no minimum income, no maximum number of properties in the background. You can be aged up to 89 when you apply for a mortgage with Zephyr. Now, in terms of where this pricing sits in the market, it's not market leading by any stretch of the imagination, but I think really why this is important to you guys is it really exemplifies where lenders' heads are, both in terms of appetite to lend, so increasing their risk appetite and therefore essentially increasing the number of people they can lend to drive up new business. But also, more importantly, it really exemplifies their confidence in terms of what's going to be happening going forwards with property prices. So for those of you who have been on the journey through COVID with us in these videos, you will remember that at the start of the first lockdown, the number of lenders who withdrew from the higher loan to value lending space was really quite significant. I mean, pretty much everyone stopped lending at 80% loan to value. Some lenders even cut their loan to values down below 75% because there was some real nervousness in terms of what was going to happen in the property market. There's also an additional factor of the fact that valuations weren't able to take place. So some lenders were relying on automatic sort of desktop valuations. There's a kind of additional layer of security built in for them there in terms of lower loan to value and then being able to continue to lend during lockdown. But really, what's key here is the fact that lenders are coming back into the 80% loan to value space. And this really indicates to us that there is no expectation of house prices tanking, falling off a cliff. Sure, lenders might be expecting the growth to soften. I think that's only natural that they would expect that given the kind of rapid increase that we've had most recently. But actually, no lender would be looking to increase their loan to value, their exposure in that way, if they're expecting property prices to come down. The Yorkshire Building Society have made some downward pricing to their buy-to-let product range of up to 20 basis points. Their rates now start from 3.2% on 5-year fix and 3.7% on 10-year fix. Now, I don't think we've ever reported on the Yorkshire Building Society on this video before, just because they don't change their pricing around very often. But they're actually a really interesting lender, so I just wanted to go into what they do in a little bit more detail for you. So first of all, the Yorkshire Building Society were previously the Norwich and Peterborough, and they got bought up by the Yorkshire Building Society and they've now been amalgamated into their brand. But they're still very much the same lender, and with the same people looking to underwrite cases with the same appetite to lend. And the Yorkshire as a commercial lender have this kind of product set which is available for buy-to-let properties. They only lend to limited companies. Anything for personal names needs to go across to their sister brand called mortgages. Now, when you apply for a mortgage with the Yorkshire Building Society, you are going to be dealing with what are essentially commercial underwriters. So they're very, very, very intelligent people who are very skilled at understanding complex situations. To this end, the Yorkshire Building Society, as well as having some pretty decent rates actually, what I would say about these guys is that when you apply to them, there's no kind of hard and fast rules in terms of what they will and won't do. What they're generally going to do is take a look at the case as a whole and try and understand it and see if it's something that they can get comfortable with. Where we've seen some real successes with these guys is the following: when we've seen complex incorporation applications, so where people are going from personal name into partnership into limited company. They're very, very good at complex limited company structures as well. They're very landlord friendly. They're very good at lending to those people with large exposure to the property market. But what I would say is that if you have an application where it's not quite hitting the mark with kind of more standard lenders, these guys really come into the fore in their ability to understand things that are just slightly less traditional, I suppose. So we really enjoy dealing with them. Like I say, because they're a commercial lender, they do look into things in quite a lot of detail. So for something which is very, very straightforward and therefore doesn't really need that level of kind of understanding and commercial view on it, these probably wouldn't be the lender for you, because the process is slightly more involved and also the pricing isn't the cheapest on the market. But for those people where things are slightly more complicated, these could be a really good option for you. Lastly, on the lender updates, we have seen some other pricing changes come in from lenders that we report on fairly regularly, so I'm not going to go into those in too much detail, but just to confirm that the Skipton have made rate reductions of between 0.06% and 0.25%. Their rates now start from 1.52. We've seen Accord mortgages make reductions of up to 12 basis points. Their pricing now starts from 1.28%. It still sounds so good when I say it out loud. And Vida Home Loans have also brought out some lower rates, with their pricing now starting from 2.79. Vida are a specialist lender, so this offering here is for limited companies and people with really large portfolios, that kind of thing. So last few rate changes for you this week. Okay, so like I said at the beginning of this, if you are like me and leave your tax returns to the 29th of January and then run around the house panicking you can't find all your bank statements and receipts and that kind of stuff, I have some bad news for you, I'm afraid. You're going to need to get your tax returns done now if you're looking to apply for a mortgage anytime soon. The lenders have started sending the emails that we get every year, confirming that actually the cut-off point for them accepting tax returns to April 2020 is about to end, and they will be looking for 2021 tax returns going forwards. Why do lenders do this? So if you think about this, if we submit a tax return which goes from April 19 to 20, essentially we're demonstrating income which is now over 18 or 18 months ago. And also, lenders do this every year, COVID irrelevant, right? But if you put yourself in a lender's shoes, they would be looking at underwriting based on income from 18 months ago, which doesn't totally encompass, the very, very potentially difficult time that people have been through. So what they want to do is get the more up-to-date figures. They get a more recent reflection of how people's incomes have been performing. So look, I know it's not great news and I'm sorry for this. It's one of the things that I dread every single year, hence the reason I leave it to the last minute. But like I say, if you are going to be looking for a mortgage, not all lenders are making this requirement just yet. It does tend to start to trickle through as we go forward now. But some of the lenders who have started making this statement are some of the largest buy-to-let lenders in the UK. So just know that if you want a mortgage in the next few months, I'm afraid it is tax return time for you. And there it is, another bumper week of lender changes. Will it stop? Who knows? It feels like it's been going on for a long time, this continual pricing reduction. At some point, lenders do just duck out. At some point, things stop making sense for them. These guys are businesses, they need to make a return on their money. They can't go, rates can't go down, without limit. But, at the moment, things continue to reduce. And so, obviously, as people who are borrowing money, this can only be a good thing for you. If you have any questions about what you've seen today, we'd love to hear from you. 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. We'll be back at the same time next week. I will look forward to catching you then. Thanks so much for joining us and have a great week.